Hello, this is Brian Resney. It's question and answer day. One of the questions I'm getting a lot in the last probably 3 or 4 months is specifically about high yield bonds or high yield bond funds. I've seen a lot of investors, of course, not our clients of our firm because we manage their money, we control risk, and we would not want to buy an inappropriate asset that's out of favor. But generally speaking, high yield bonds are probably the most overvalued individual sector that we review on a daily basis. High yield bonds have interest rates that are at all-time lows of over 20 years. Valuations are extremely stretched. And in fact, I believe most high yield bonds or bond funds are probably 50 to 80% overvalued. Most people don't realize high yield bonds act very much or are very much correlated to the U.S. Stock market. What that means is this: when we go into the next recession, whether that's a year from now or 5 years from now, often in recessions, high yield bond and bond funds drop as much and more than U.S. equity-based prices. So given the current valuation of high yield bond and bond funds being overstretched, given the low interest that they are currently earning, you basically are taking substantial risk owning high yield bond and bond funds in order to get a little bit of return, and you have tremendous downside risk. I would rather look at equity sectors within the U.S. that pay higher dividends, diversified, that are lower valuations, that have some upside potential and not as much downside risk as high yield bonds. If you own high yield bonds, make sure you understand high yield bond funds, again, can have as much or more risk and fall more than the U.S. equity market in the next recession. If you're not a client of our firm, call us for a consultation. There is a difference. We invite you to experience it. Have a great day.